In this video, I will reveal the number one candlestick pattern that actually makes profits. It's called the double green or double red candlestick pattern. The double green candlestick pattern is a bullish candlestick pattern that can be used as a buying trigger. Similarly, the double red candlestick pattern is a bearish pattern that is used as a selling trigger. However, you can't use this candlestick pattern alone. So, once we master this candlestick pattern, I will also reveal my exact sniper day trading system that uses 3 indicators to help you identify the highest probability trade opportunities. The double green candlestick pattern is a 2-candle formation that signals a bullish momentum in price. Here are the exact rules of this candlestick pattern. Rule number 1. The first candle must be a green candle. It can be of any shape and size, but as long as it's a green candle with a visible body, the first rule is satisfied. Rule number 2. The body of the second candle must be bigger than the body of the first candle. The difference in size must be obvious. It indicates that the buyers were able to cover more distance on the second candle over the first candle. In other words, it shows buyers are gaining more momentum. Rule number 3. The high and low of the second candle must be higher than the high and low of the previous candle. It shows that the price is making higher highs and higher lows on the lower time frame. In other words, the price is in an uptrend on the lower time frame. Rule number 4. The close of the second candle must be above the high of the previous candle. It indicates that the buyers are strong and they are able to take the price higher and keep it there. Rule number 5. The close of the second candle must stay near its high. In other words, there must be a very small or no upper wick. This indicates that there are a minimal or no sellers to bring the price down. The buyers are dominating and closing the prices at their will. When we see this pattern on the charts, it indicates an acceleration in the upwards momentum. So, we can expect the price to continue upwards for the next 3 to 5 candles. Double red pattern. The double red candlestick pattern is the exact opposite of the double green pattern. It's a 2-candle formation that signals a bearish momentum in price. Here are the rules for this pattern. Rule number 1. The first candle must be a red candle, any shape or any size. Rule number 2. The second candle must have a bigger body than the first candle, and the difference in size must be obvious. It would indicate that the sellers are gaining momentum. Rule number 3. The high and low of the second candle must be lower than the high and low of the first candle. It indicates that the price is in a downtrend in the lower time frame. Rule number 4. The close of the second candle must be below the low of the previous candle. It indicates that the sellers are strong and they are able to take the price lower and keep it there. Rule number 5. The close of the second candle must stay near its lows. In other words, there must be a very small or no lower wick. It indicates that there are a minimal or no buyers to bring the price up. The sellers are dominating and closing the prices at their will. When you think about it, this candlestick pattern indicates an acceleration in the downwards momentum. So, we expect the price to move downwards for at least 3 to 5 candles. Now that you know exactly how to spot a double green or double red pattern, you might be tempted to trade every single one you see. Don't. This is a very common pattern that occurs on a lot of the charts. Trading all of these patterns would be a big mistake. Context matters. For example, the double green pattern can occur at the start of a new up move or late in the up move. A buy trade at the start of an up move is a good trade because the buyers have just entered the market and are ready to run. But a double green appearing late in the up move might be a sign of exhaustion. Since the buyers have taken the prices up already, they might get tired. This increase in momentum might just be a last push from the buyers. This is where the retail traders get trapped. They see this signal and buy just as the big players are looking to exit. Don't make this mistake. The overall trend is also a good way to filter losing trades. When the price is in an uptrend, there is a high probability that the trade will move even higher. So a buy trade after a double green candlestick pattern is a high probability trade. But a sell trade after a double red candlestick pattern is a low probability trade because the chances of a down move are less. On the other hand, in a down move, there is a high probability that the price will move even lower. A sell trade after a double red pattern is a high probability trade. However, a buy trade after a double green pattern would be a low probability trade. When we consider all of this, the best way to trade this pattern is to look for a double green pattern at the start of an up move in an uptrend. Similarly, looking for a double red pattern at the start of a down move in a downtrend. Now let's try to do this with the sniper day trading strategy. But before we learn this strategy, if you want to take your trading to the next level, be sure to check out our Prime Trader program. We've bundled our 3 most powerful courses into one single program for the price of one. It is the definitive roadmap to becoming a professional trader. You can find the link in the description below, but for now, let's dive into the sniper strategy. This is a day trading strategy, and I use the 5-minute charts to trade this. For this strategy, we need to plot 3 indicators: RSI, VWAP, and SuperTrend. Here's how to set up these indicators. Head over to TradingView and click on the Indicators tab. Type in VWAP. Click on this option and plot it on the charts. Click on the settings and disable the Bands Multiplier. That's the VWAP setup. We will use the VWAP to identify the trend of the market. When the price is trading above the VWAP, it indicates that the price is in an uptrend. So, we will look to trade the double green candlestick pattern. Similarly, when the price is trading below the VWAP, it indicates that the price is in a downtrend. Hence, we will look to trade the double red candlestick pattern. Next, we plot the SuperTrend. Head over to the Indicators section and type in SuperTrend. Plot this indicator and go to its settings. Under the Input section, change the factor to 2. Click OK and the indicator is ready. We will use the SuperTrend for a second trend filter. It will show us the short-term momentum of the price. If the SuperTrend is green and the price is above the VWAP, we will look for the double green candlestick pattern. Similarly, if the SuperTrend is red and the price is below the VWAP, we will look for the double red candlestick pattern. If both of these indicators are giving opposite signals, we will avoid trading. For instance, here the price is trading above the VWAP, but the SuperTrend is red, so we avoid trading. On this chart, the price is trading below the VWAP, but the SuperTrend is green. Again, we avoid trading here. We will only look for trades when both of the indicators are either bullish or bearish. But as a final momentum filter, we will use the RSI indicator. Go to the Indicators section and search RSI. Click on this option and head over to its settings. Change the RSI length to 2. Then go over to the Style tab and change the upper band to 80 and the lower band to 20. Disable the middle line and these 3 options. When the SuperTrend and VWAP are bullish and we see a double green pattern, we will look at the RSI to see if it's above 80. If it's above 80, it confirms the bullish momentum, so we enter a buy trade here. Similarly, when the SuperTrend and VWAP are bearish and we see a double red pattern, we will look at the RSI to see if it's below 20. If it's true, it confirms that the price is in a bearish momentum and we will enter a sell trade here. Trade examples. Here we see that the price was trading above the VWAP, which indicates that the price is in an uptrend. The SuperTrend turned green here, so we start to look for a double green candlestick pattern. Here we have a double green candlestick pattern. It has higher highs, higher lows, higher closes, bigger body, and a close near its high. So we look at the RSI, and it was also well above 80, confirming the bullish momentum. Everything lines up, but there's one problem. Remember, context matters. The pattern checks all the rules, but it has occurred pretty late in the up move. The price is already moving up for the last 7 candles. It seems we are at the end of an up move, so we avoid trading here. If we had to place a buy trade here, it would have made profits, but that is not the point. We need to follow the strategy rules. Soon enough, the price makes a pullback and we finally see a double green candlestick pattern. We have a higher high, higher low, higher close, bigger body, and a close near the candle high. The indicators are also aligned. The price is above the VWAP, the SuperTrend is green, and the RSI is also above the 80 level. This signals that the pullback is complete and that the buyers have entered the markets. They are building momentum and they are ready to take the price higher. So we enter a buy trade at the close of this candle. We keep our stop loss below the entry candle and target a 2:1 risk-reward ratio. If the price touches our targets or stop loss within the next 5 candles, it's perfect. But if it doesn't, we will exit our trade at the close of the 5th candle. As you can see, the price achieved our targets on this trade. Here is another example. On this candle, the price breaks below the VWAP and the SuperTrend also turns red. It indicates that the price is starting a new downtrend. In a downtrend like this, we will look to trade the double red candlestick pattern. The down move continues and we have 2 double red patterns here. But we avoid trading them since the price had already moved down a lot and these patterns happened pretty late in the down move. The price then makes a weak pullback here. When the price starts to trade lower again, we see a double red candlestick pattern here. We have a lower high, lower low, lower close, bigger body, and a close near the candle low. We look at the RSI and it is also trading below the 20 level. This confirms that the sellers have entered during this pullback and they are gaining momentum. It is a sign that the sellers will continue to move the price lower over the next few candles. So we enter a sell trade at the close of this candle. We keep our stop loss above the entry candle and target a 2:1 risk-reward ratio. Over the next few candles, the price achieves our targets. If you liked this strategy, then leave a like and subscribe to our channel to never miss our new videos. And if you want to learn more strategies like this, join the Prime Traders program. Links are in the description below. See you soon.